Hi and welcome. I'm Martin Perron, mortgage broker and Smith Manoeuvre professional certified. I discovered the Smith Manoeuvre and the cash dabbing strategy after I did something that triggered a massive tax bill. After a change in our family situation, we had to move properties from a trust to our personal name. And this triggered a massive tax bill with CRA. My husband and I knew that if we were to take the money from our corporations to pay CRA, it would trigger more taxes. And we had to find something different. Cash damming changed everything for us. This is why I'm sharing today this powerful strategy specifically for rental property owners. The cash flow dam is both a standalone strategy and a specific accelerator of the Smith Manoeuvre. This presentation is to show you how to optimize your rental property cash flow for maximum financial benefit. Whether you own one investment property or more, these concepts can significantly improve your financial position. There is a fundamental distinction we need to understand about debt. Non-deductible debt, like your primary residence mortgage, costs you money with no tax benefit. Tax-deductible debt, like rental property mortgage, provide tax advantage while building assets. The key to building wealth isn't avoiding all debt. It's converting expensive debt into strategic debt. Most Canadians don't realize they can transform their personal mortgage into a tax-deductible debt. Cash flow dam is a debt conversion strategy with three key benefits. First, it transforms your expensive personal mortgage that's non-tax deductible into a tax-deductible investment debt. Second, this creates a significant tax advantage through careful restructuring of existing cash flow. Third, it requires absolutely no additional money. We're just reorganizing what you already have. This isn't about adding more debt. It's about making your existing debt work smarter for your future. Let's look at the specific advantage this strategy provides. You'll pay down your personal mortgage much faster than scheduled. You'll create a valuable tax deduction. Your monthly cash flow will improve through tax savings. Your rental income will get redirected to pay down your mortgage. All of this happens without requiring any new monthly money. We're simply working with the rental income you already have in a more efficient way. This is how most investors, property owners, use their cash flow. They take the rental income they're getting and they pay for the rental expense. You probably are doing the same right now. The problem with this strategy or this setup is there's no tax advantage on your own mortgage, and it limits the ability for you to prepay your mortgage on your principal residence. But the cash flow dam strategy is to help this. Instead of using the rental income to pay for the rental expense, we'll use it to prepay your personal mortgage, which would open the line of credit that would pay for the rental expense. But I'll show you in details how we can make this work. Before implementing this strategy, you need one crucial financial tool: a readvanceable mortgage on your primary residence. This specialized mortgage structure is the foundation of the entire strategy. Without this setup, you won't be able to access your equity as it builds. Many major Canadian banks offer readvanceable mortgage, and they vary in features. If you don't currently have one, this will be our first step. A readvanceable mortgage looks like this. You have a monthly payment of $2,200, $1,470, which is not tax deductible, is interest that goes to the bank. That's on your primary. And you have $730 that's available because it's your principal that's been paid down and it is now showing on the line of credit. This is how you know that you have a readvanceable mortgage product. Now we're going to use this structure and make it work with your rental income to apply the cash damming strategy. Step 1, you receive a rent payment. Then you use your monthly rental income to make an additional prepayment on your primary residence mortgage. This prepayment plus the regular principal reduction creates available credit on your HELOC. Step 2, transfer the newly available HELOC room created by your mortgage payment and your prepayment to the Smith Maneuver clearing account. Step 3, use this cash to pay all the expense related to the rental property, including mortgage payment, strata fees, municipal tax, insurance, etc. Let's go over a scenario so you can see the numbers and how it works. This specific scenario, there's a neutral cash flow, meaning there's enough rental income to cover for the rental expense. But whether you're in a negative cash flow where there's not enough rental income to cover for the rental expense, or you're a positive cash flow, meaning you have more rental income than expense, we can all make that money work for you. Here, we have the primary residence with a $400,000 mortgage, 25-year left on the amortization with a 4.5 interest rate. And on the other side, you have the rental property with a mortgage of $680,000, amortization left of 30 years, same interest rate. And now we see how the mortgage payment and the property tax, insurance, everything is there. By using the rental income to prepay the mortgage on the primary residence and using the HELOC to pay for all the rental property expense, this couple received $100,000 in income tax return over 22 years. They have converted their whole mortgage debt in 65 months. This represents about 5 years and a half. That means that after 5 years and a half, the whole $400,000 was now tax deductible. The debt, after being converted, was fully reimbursed in 257 months, which means they saved in amortization 43 months. So they paid the mortgage faster and they were able to convert it in 5.5 years. What would it mean for you and your family to be mortgage-free years earlier? The strategy helped you pay down your mortgage faster, save income tax, and build asset for. When dealing with CRA, because there's tax refund here, you want to make sure the strategy works correctly. So you need a professional setup. You need clear documentation, and you need regular review and monitoring. Consistency is key. Are you ready to start? First, we need to connect, review your current expense on your revenue property and your rental income, check your mortgage eligibility because we need to make sure you have a readvanceable mortgage on your primary residence, and then we set the structure. Financial freedom is closer than you think. Let's connect to get you started on the cash damming strategy.